Welcome, everyone. Today, we're celebrating our 50th episode titled And Yet It Moves. Congratulations to our hosts, Mike Green and Harley Bassman, on reaching 50 episodes. Our special guest today is Davidson Heath. Davidson is an associate professor of finance with tenure at University of Utah's David Eccles School of Business. He's a former derivatives quant and trader. He holds a PhD in finance from USC Marshall and an MBA in finance from Chicago Booth. Harley, you're not smiling. His research includes index funds, commodities derivatives, trademarks, and intellectual property. Any one of those can make for an interesting discussion, so I'm looking forward to the conversation. As a reminder, today's discussion is sure to be entertaining, but is not investment advice. Also, the chat feature is disabled, so if you have a question, you can submit them through the Q&A function, and we'll address them along the way. So with that, I will turn it over to Mike.
Thank you very much, Clint. I appreciate it. Davidson, it's great to have you on. I know that Harley gave you the warning in advance that we tend to be like the old guys in the Muppets going back and forth, so don't hesitate to throw peanuts at the peanut gallery. One of the reasons why you and I connected was you wrote a fantastic paper in 2017 called On Index Investing. And I emphasize that it is actually a really fascinating and great paper because you focused on a very particular subject. And I just want to jump to the abstract of the paper because I want to hit on this before we jump to anything else. So your paper had as the abstract on index investing, and you looked at something really interesting, which is basically the production of information as it relates to index inclusion. So once a stock enters an index, does the information that is available on it, analyst coverage, earnings reports, everything else, does that increase or decrease? And what you found, I thought was fascinating, which is that there was a significant decrease in what I would describe as basically traditional or fundamental information, things like Google searches, Edgar reviews, analyst reports, those all fell. Is that the correct conclusion?
That's correct, Mike. And by the way, thanks very much for having me on, guys. And I surely appreciate being the 50th episode. That's pretty wild. And I appreciate the Galileo comparison as well. I'll try to live up to that.
I like it. I like it a lot.
But that's right. We found that stocks that switch into an index where they're more highly weighted, namely they go to the top of the Russell 2000, so they have an influx of passive investing and holdings by passive funds, and fundamental information production about those stocks also fell as a result.
And then there was a second part of the paper, which is where you and I really connected and pushed. And by the way, I think the observation on the information production is fantastic. And it's something that you and I have talked about extending effectively, because it really goes to the heart of how we think about what information ultimately means. But then there's a second part, which I've highlighted in green. The yet price informativeness remains unchanged. As a result, passive investing does not undermine price efficiency. To me, that was a very surprising outcome, right? Information content falls, and yet price inefficiency is unchanged. Maybe you can explain kind of how you guys approach that and what you were thinking about there.
Great. So let me talk about, there's both a sort of theory component and then there's also an empirical component to it, right? Yep. And so let me talk about the theory component first to kind of set the cast of characters, and then we can talk about the findings. So on the theory side, I would say we had a model and some predictions that kind of rationalized this finding, which were based really around, it was based around like a Grossman-Stiglitz, the famous Grossman-Stiglitz model of information acquisition in markets. But really, I would say the real genesis or the real fundamental driving assumption was closer to the famous Sharpe arithmetic, which I teach every year in my finance class and so on and so forth. And it's a very simple, beautiful argument, right? The Sharpe arithmetic, due to the great Nobel Prize winning Bill Sharpe, says that if passive investors just park their money in a passive fund and then wait till the end of the period, they get the exact market return. And therefore, the individual and all the active investors, therefore, are also fighting over the market return. And it's a zero-sum, competition between them, right?
Yep.
And similarly, in the model that we wrote in the paper, that kind of shocking, that kind of very surprising conclusion that information efficiency doesn't change, the fundamental assumption that drives that in the theory is that similarly, investors can just opt out of the whole trading and trying to make returns game. They can just park their money at the start in an index fund and wait till the end of time and then collect the exact market return. Okay. And as a result, the active traders, all of the active traders in the market are fighting over essentially a zero-sum game to try to, if one beats, then one must underperform and vice versa, right? And so that's kind of the key assumption that drives that conclusion in the model. And then when we took this to the data and we investigated, again, these kind of index switching events, what we found is consistent with that in the sense that we found no significant change in certain measures of price efficiency, most of all variance ratios that say that the price trajectory or the return trajectory of any given stock that was treated in our empirical setting was no more or less random walkie than it was before.
Okay. Okay, so now one of the key things that you just highlighted is the Grossman-Stiglitz paradox. So let's just take a second to jump over to that. So let me share this slide. Sorry. I think that's right. Okay. Okay, so the Grossman. Yep. Nice. There we go. Okay. So the Grossman-Stiglitz paradox is a paradox introduced by Sandy Grossman, who was actually a professor of mine at the Lesser School of Wharton relative to Chicago. And by the way, I hated him. He actually gave me a B in option theory, if you can imagine. We couldn't get over the idea that prices perfectly reflected all information. I was fighting that even back in the early 1990s. So it'll give you some idea how long I've been fighting against that idea. But the idea is very straightforward, right? That you cannot have perfectly efficient markets because otherwise there would be no information, no incentive to obtain information. That information is supposed to drive a forward return, right? If I have better insights into Apple's earnings or dividend payments or anything else, that's theoretically supposed to give me better insight in terms of what the next period price is going to be, and therefore I generate a superior return if I've paid to gather information. Okay, now one of the things that I think is so fascinating about this is that it effectively assumes perfect competitive response. So, what is ultimately happening here in your model is you're saying, yes, more people are opting out, but the people that are left are trading even more aggressively on information, and therefore prices are largely unchanged in their overall behavior. And that's kind of the crux of the argument, right?
I would say they're trading more aggressively per unit of information gathered, but they're gathering less information because the stakes are lower in some sense. And those two effects are balancing each other perfectly because of the 100% competition, 100% free entry competition assumption. That's right.
And so one of the things that I find so interesting about this is that it's basically just a theory of markets, right? If markets are perfectly competitive, markets are going to be perfectly competitive. And what we've found over the past couple of years, and Haddad and Gabay and Koyjin and Hugo, et cetera, have all done a tremendous amount of work on this topic. Haddad's paper is probably the most critical because it's the one that directly addresses the intra-market behavior, right? So how individual stocks behave in response to this. And what he found was that the strategic response really only counteracted about 2/3 of it, right? That competitive response only offset the behavior by about 2/3. And so that actually creates a very different potential outcome, right? Not one that has to occur, but certainly one that could occur, which is if there is a continuous forcing from something like passive, that we would just fall further and further behind effectively in our competitive response And as a result, prices would deviate, but we might not necessarily see that change in other ways. That for me was the starting point. But what I actually thought was the most interesting thing about your paper was the fact that it was focused on information production much more than it was on valuation or prices or anything else. And so if I jump to this idea of what is information, right? The idea is super straightforward, right? We have two different types of assets. One's a risk-free asset, so it's absolute certainty in terms of its return. And another one that's a risky asset that has some sort of information content, right? Typically thought of as like a single period dividend or earnings or revenues, whatever, that helps to drive return, right? So the model in Grossman-Stiglitz is a risky asset return is equal to some information component, an error component, basically predictable return and the error return. And what I loved about what you highlighted or what your paper really kind of brings out, particularly if we think about it in the context of removing some of that perfectly competitive market component, is that it actually emphasizes that that information might not be fundamental at all. And if fewer and fewer people are effectively trading off of that fundamental information, the dominant source of information becomes very different. Instead of focusing on earnings projections or discounted cash flow models or even a Monte Carlo simulation in an Oswald de Modern type framework, the new information really became all about flows. And Harley, I don't know if you follow, I know you're less involved in equities than I am, but I see this everywhere in my email, right? My inbox is filled now with reports of positioning and flows and option market data, some of which I produce my own. And the last one I would just emphasize is the payment for order flow. Today, we just got news that Citadel bought Morgan Stanley's stock option trading business, right? Why? Because Morgan Stanley can no longer compete for payment for order flow. Their market share had basically fallen far enough that they were no longer able to pay competitively to obtain the information. Now you've got, I mean, it's really a remarkable antitrust observation. I think Citadel's market share was somewhere in the neighborhood of 40%. They just acquired the 7% provider, so they brought themselves almost to 50%, which is extraordinary when you really think about it. But any pushback that you would have on kind of this reframing, because this to me is by far the most important thing that's come out of your paper. I no longer get discounted cash flow models or full workups from sell side analysts. All I get is who owns it, who's buying it, what index is it in, and we see this echoed across the sphere, across the information sphere in the stock market. That's all anyone cares about anymore.
Yeah, very good. So so let me go in reverse order then and talk about so the first thing I would say is there's this, when Mike, when you started peppering me with criticisms and arguments and so forth, as you like to do, in the back of my mind, everyone who's written a model or who's written any analysis ever has this kind of I call it mentally, I call it the Borges response, because it's really, the story by Borges about the guy who wants to create a map of his kingdom that doesn't leave anything out. And so it has to be a one-for-one copy of the entire kingdom, right?
Yep.
And so, the point is, it's not a critique to say to someone, hey, your analysis, your model left this thing out, because
by definition,
this will always be true, right?
Yep.
The ask is, okay, you have to convince me that I left something out that's fundamentally important, right?
Yep.
It's critical. And so between our conversations and also you, Mike, raised to me this wonderful paper which I recommend to everyone called "Sharpening the Arithmetic" by
Lasse Peterson.
By Lasse Peterson in the Financial Analyst Journal, FAJ, a while ago now. And in that article, Peterson points out for that sharp arithmetic where he says, okay, we have this famous argument that active investors are just fighting between themselves because passive investors can just essentially opt out of the whole game. And he says, well, okay, but that assumes that on the demand side, that those passive investors can just, at the start of your life, you park all of your net worth in a passive index fund, and then you wait till the end of your life, and then you withdraw, right? Yep. And of course, on that demand side, that's ludicrous. All of us are, those of us who are working are putting in every 2 weeks We're
Yep.
flowing money in every 2 weeks or whatever it is into our, retirement options or whatever it is. And then when we retire every month or couple months or whatever, you're going to withdraw to, in Mike and Harley's case, you're going to withdraw to buy another private island or whatever. And for me, I'll withdraw to keep my cabin, to buy some more cat food to eat in my unheated cabin. But the point is, so on the demand side, that assumption is just simply not accurate.
Yeah, it's
Right?
crazy.
Simply wrong. And there's flows. There's going to be regular flows in and out of the passive vehicles, and your model should account for that. And then on this, let's call that the demand side. And then Peterson points out on the supply side, firms are merging and are issuing shares and are doing buybacks on a regular basis. And so if your timing of your active or your passive flows happens to line up, right, with those other events, then suddenly all bets are off, essentially.
Yep.
And it's possible for active to outperform as a class. It's possible for et cetera, right? All the bets of the sharp arithmetic kind of go out the window. And that reflection was really important to me. And I realized, yes, okay, that is a first order issue. And so so I agree that we have to think about the flows on a regular basis. And that kind of puts all those other assumptions potentially out the window.
Yeah. I mean, that really was kind of the big breakthrough for me. That's why I share that paper and speak so highly of it, is it's just like, wait, this whole thing fails on its very first principles, right? The
Yep.
idea that you can somehow magically enter the market with all of your capital at time zero before anybody else is, technically before the market even exists in a bizarre way, right?
Good.
And that you're never going to touch it. In other words, the idea, the definition in Sharp of passive is somebody who always holds, never trades. And the minute you trade, you cease being passive, you become an active trader. And then it actually becomes an entirely different analysis process, because what you're actually identifying is, wait a second, instead of a passive investor, I'm talking about a systematic algorithmic investor who operates off of very simple rules. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. And to think that somehow that participant is unique in their inability to impact the market, particularly as it went from about 2% market share to, my estimate is, inclusive of all the separate accounts and CITs and total return swaps and everything else at this point, that we're north of 50% that is now passive. It struck me as so absurd. Like, that paper was the light bulb going off for me.
So let me ask Mike, is this argument vitiated a little bit by the fact that Marco Salmon and Alex Chinko have a nice paper, which you're well aware of, that says, hey, the passive fraction is actually way bigger than you might think, because a lot of other folks that we would classify as active investors are sort of closet indexing or following similar systematic simple rules. And in the aggregate, they kind of have to hold something pretty similar to the market portfolio. And so so my point is that the rise of passive, like legitimately passive qua passive, like VTI,
Yep.
may not necessarily represent such a sea change. I'm trying to push back here.
Yep.
Because that was already happening under the radar with a bunch of active funds who were effectively following the total market and collecting 75 basis points for it, and essentially closet indexing. What do you think about that argument?
No, I think it's a super important one. One of the things that we have seen very clearly, actually, is that category, effectively, of closet indexers has increased over time. It hasn't decreased over time. And so my work, and ultimately I think yours, would reflect some of the same component. Part of what they're doing is they're simply operating in a defensive regime, right? I can't deviate that much from the benchmark, because then I'll get fired. I'll have tracking error. I run risk that I might not have if I'm able to stay relatively close to the index. And so, if anything, I actually would highlight that this is another topic we've talked about, which is effectively defection, right? People start cheating versus their historical models in order to continue to persist. Again, that information flow tells me that that's part of what's actually playing through here as well. The market has basically changed its approach. It's moved from being focused exclusively on value or identifying what a forward discounted cash flow type model. And I understand it's never exclusive. There's always going to be different players. But we have absolutely seen that increase rather than decrease. And I would argue that that is complementary rather than substitute.
Yeah, I think that's a super interesting idea. The idea, if I can restate it in words of one syllable, for
Yep.
me for me to understand, is that as passive grows, and if you take this flows are first order important argument
Yep.
seriously, then as flow-based information and flow-based swings in prices loom larger and larger relative to fundamentals, the tendency among previously active or still active managers to closet index actually goes up as well.
Yeah. Yeah. And that is what the evidence would support, right? You're effectively just trying to stay alive.
Yeah.
And no, that's not a prescription for winning in the long term, but it is, the first rule of order, if we do an order of operations, is make sure you survive the encounter, then try to win the encounter, right? It's a totally different framework. And in an environment that we're in, where I would argue that actually distribution is probably the single biggest challenge that people have, gaining access to investors, which changed radically with the Pension Protection Act in 2006, that introduced this idea of qualified default investment alternatives. You're young enough, Harley is a little too old to remember this. You're young enough, you may not fully remember it. But you used to, as a mutual fund manager or as a separate account manager, you used to compete all the time for retirement program assets. And now like sponsor programs, they will not even offer active management choices, right? You are automatically defaulting into a qualified default investment alternative, which is almost inevitably a target date fund. And so that issue actually has gotten bigger and bigger for active managers as they've seen net redemptions. Basically, nobody wants to lift their head up. Right. Nobody
Yeah.
wants to draw attention to themselves one way or another. Occasionally you get Kathy Wood at ARC that knocks the cover off the ball for a very short period of time. And perversely, as you know, in the academic literature, we're now finding that she may have actually created her own return stream through her flows, right? But that will happen. It just doesn't actually determine long-term success, as the performance of ARC or other strategies like that might suggest is been vindicated once more. The other thing,
Mike and Davis, I have a question for you. Coming from 30,000 feet down to the ground again, is this whole concept here that it's a zero-sum game, so why bother fighting it, just buy the index fund? Or are you saying because of this, there are opportunities to go and win?
I think the answer is both, and it's also time dependent, right? So, Harley, you've obviously seen the materials that I share on this. One of the perverse outcomes from this, and Davidson was actually just sharing with us before some of the most recent work he's done on elasticity and the changes in elasticity that we're starting to observe. But one of the most important things that ultimately comes out of this is that there's nothing you can really do to outperform the benchmark if everybody else is flowing their money into the benchmark. It becomes very much like the carnival game where you go and you try to inflate a balloon or race a horse by shooting water into a clown's mouth, sort of thing, right? The best strategy for that game is to actually sign up with your friend sitting next to you and you both shoot at the same target. So you're putting more water pressure on the target, filling it up faster, causing the horse to race faster, etc. You end up splitting the prize, but you dramatically raise your odds if you're working with somebody else in the same way. This is the same underlying phenomenon. Effectively, the stocks that will not ever be sold and must be bought within the indices become increasingly inelastic. They lack substitutability. And so your best strategy is to chase after them.
But I wonder about this whole presumption that markets are a zero-sum game, because there's not. I mean, as Davis and I both know, when we took Bob Hamada at Chicago, the first day at 332, they're giving us the 13 market inefficiencies of why this whole thing class we're going to take is all ridiculous, because that overwhelms everything else. And I'm thinking about like the fund that you manage, where you basically buy a total return swap of index plus 50, and therefore you've beaten the market no matter what. Why? I mean, it's inefficient because Morgan Stanley, Goldman Sachs needs to pay us money for insurance and our balance sheet. But I mean, you don't include that in your story, so therefore this entire presumption of it's a zero-sum game is bogus.
Well, I think we all would agree that, again, it goes back to Davidson's observation, right? The minute you build a model, you have to exclude certain features to it. The presumption that everything is perfectly efficient is far more aligned with a Grossman-Stiglitz type framework than it is with what we're actually talking about. So if anything, I think both Davidson and I would emphasize there's all sorts of inefficiencies that you can take advantage of. There's a reason, by the way, that the high yield fund that you're referring to is doing it in the high yield space as compared to the equity space. You can't replicate that behavior in equities, for the very simple reason that very few of the broad indices are shorted as much as something like HYG might be shorted. There's also just a broader question of what do you mean by the benchmark? So most ETFs in the fixed income space actually underperform their benchmarks because of difficulties in full replication. There's just simply too many CUSIPs in high yield for something like HYG or JNK or ANGL, all of which represent the high yield space, but covering different components of it, et cetera. It's simply impossible to fully replicate that number of CUSIPs. And this is true in the bond funds, et cetera. Some of the more recent work I've been doing is actually around the relative exposures on the curve that happen in risk-free rates before and after you see extreme moves in interest rates. So like the observation I would make is that fixed income is significantly less efficient, in part because of the number of CUSIPs that you're ultimately dealing with. And as a result, that type of opportunity is available there, but it's really not something that can be replicated elsewhere.
Well, fixed income, it's easier to beat because the average life is 5 years. And so each new deal gets rolled over and you get the issuance teaser, whereas equities is forever issuance. So it's very easy for a fixed income guy to beat the index.
Well, I appreciate you downgrading my efforts, but it's I think that's right. I mean, this is one of the reasons why I do emphasize active management and fixed income. The other component is even under a purely theoretical model, and I think Davidson and I would both embrace this. You can create an argument for market cap weighting or float adjusted market cap weighting in equities, right? Because equities are ultimately Ponzi assets, and that you're the vast, and I know that's a loaded term, but
Infinitely lived, maybe.
yeah, infinitely live. Ultimately, what you are capturing in your return is almost exclusively tied to what somebody else is willing to pay you for when you decide to exit that position. There's very little endogenous liquidity, which brings in the point that David Einhorn was raising when he brought up this concept and referenced my work in terms of markets are broken, right? What he was identifying is in a world that is dominated by passive investing, he would look for equities that have endogenous liquidity. In other words, they return the investment and capital to him through buybacks, dividends, et cetera, rather than him waiting around for somebody else to recognize his genius in having selected this idea and paying a higher price for it, right? Bonds are the ultimate endogenous asset. It's one of the reasons I love high yield, right? In any given year, roughly 25% of my fund is returned to me in the form of maturities and coupon. So you're constantly doing exactly what you're saying, Harley. You are reinvesting in the next new issue. You are reinvesting those proceeds. That can create all sorts of interesting challenges in an environment in which is relatively low issuance right now, for example, in the high yield fixed income space, which means we got a flood of capital that is being generated through coupons and to a lesser extent maturities, even lesser extent inflows, which have been largely fixed in the high yield space. But the reality is you got to put that money back to work. You don't have a
I suppose, I mean, the VIG is, I guess, if you look at the entire world of money, it is zero sum, but we're not doing that here. So basically, the issuer is paying the VIG, and we don't count him in the game.
Yeah, I think that's right. And actually, Davidson, your thoughts there would be interesting because one of the other features that we are seeing much less of are IPOs, certainly relative to market peaks, et cetera.
Yep.
You would think this goes back to the supply demand component that supply would be relatively elastic, that companies would be selling shares in this environment, raising capital.
Yeah, so again, Marco Salmon and John Shim, who are two really, really smart, terrific guys, have this very provocative paper. It was just cited in The Economist and stuff, I think, right? Where they claim that the data says that companies are indeed kind of fulfilling that issuer or buyer of last resort, that firms themselves, their new issuance and their buybacks tends to be that last resort, or residual for those index fund flows. Now, I have to say that's an extraordinarily interesting and provocative statement. I still am a little bit skeptical, not because, I mean, Marco and John are both like 50 times smarter than me. So combined, that's like 100 times. That's like, oh, that's, I don't know what 50 plus 50 is, but you get the idea. It's a lot
Yeah.
smarter than, but I'm still a little bit skeptical that that can be true simply because I mean, you don't hear like Jensen Huang saying like, oh, you know, because these idiot index funds are overbuying Nvidia stock, we're going to issue more than we otherwise would have, right? Like you know, the mechanism itself, I just is hard for me to buy. But
Well,
that's what the Salmon and Shim paper says.
yeah, so actually I'm going to jump to the salmon and shrimp paper, and Olga is going to kill me because I'm using a non-approved chart here, but it is in public document. So give me 2 seconds to pull this up because the picture on this is I've talked with Marco quite a bit on this. Give me 1 second here. So in that paper, they have a let's see, let's just see here. Is this what I want to show? Yeah, this is what I want to show. So they have a series of really interesting charts that basically look at this dynamic of as index fund ownership increases or decreases, who are the providers of shares that allow them to increase their position.
Right.
What's actually happening in this firms, note the shape. So this is firms selling, short sellers selling, et cetera. Short sellers, actually work in a manner that is not dissimilar to how firms are doing it. It's one of the reasons why short selling is important. When a market crashes or when a market runs up, those short sellers are then chasing in the same way. But the supply of shares from firms, look at this picture. What does that look like to you?
It almost looks like a hockey stick, right?
Well, it's downward sloping hockey stick or a short call position.
Yep.
So what's actually happening, and Marco's doing work on this as we speak, is that it really is employee stock ownership grants that are occurring. So as prices move to new all-time highs, those insiders are selling shares.
Effective issuance.
Yeah. Effective issuance as compared to direct issuance.
Hmm.
And so like this is, it again is one of these things where you're like, wow, that's really incredible that's the finding. Why am I not seeing a bunch of secondaries? Why am I not seeing a bunch of IPOs? And the reality is it's a continuous process, which again goes back to your fundamental information point. Nobody cares about insider selling anymore, right? That used to be like the most important indicator we were supposed to track, and nobody cares.
Yeah, it's a really interesting point. Just to go back, I thought Harley, you brought up a really interesting point, which is that in some sense, the high yield and the fixed income space does simply look a lot more like that sharp arithmetic Grossman-Stiglitz world, in the sense that each new issuance, you could choose to sit on the sidelines, or you could choose to evaluate it and say, oh, this is overvalued, this is undervalued, I'm going to jump in. And then either way, by the end of the maturity, or even before that, the fundamental value of the proposition is going to be like settled, right? And then you move on to the next opportunity or something like that. That looks a lot more like the Grossman-Stiglitz and that sharp arithmetic kind of world that we talked about, with a fixed lifespan where the fundamental information gets like revealed at some point, right? Whereas, as Mike was saying, with stocks, which are infinitely live, even if you want to collect a bunch of fundamental information and trade on it, it may not matter if there's enough flows that are pushing the the price the other way, right? The market can remain irrational longer than you can remain in business.
Yeah. So to not get distracted by the theory here, rubber meets the road from my ignorant point of
Coming
view.
from a Chicago grad, I'm sorry.
Yeah, exactly. Let's not let
is the elasticity of a stock relative to its market cap is not one for one. And this is where the rubber meets the road. So I want to hit on that. And then the question I'm going to follow on is, so if that's the case, isn't the answer to own the index until it's not? I mean, it seems to me it's a pro-cyclical game, so why not just, it's a momentum trade that's not going to end anytime soon, I don't think, as long as we have unemployment below 5% and everything's going, and the government's pumping in $3 trillion extra. It seems to me that only an idiot wouldn't buy passive. Mike, speaking of idiots.
Speaking of it,
Let's ask one.
yeah. No, I listen, this has been my advice all along, which is the unfortunate reality behind the theory that I have promoted is that until this stops, there really isn't a better strategy, right? And so perversely, it is a tragedy of the commons component, right? We're all going to buy passive until it becomes a bad thing to buy passive, and then one person's going to go to sell, and prices will fall very, very, very sharply. Right. At the end of the day, that really is, I was going to share a clip of Davidson highlighting this, but like that's the impossibility framework on the perfectly efficient market, right? Because ultimately, if nobody was doing the work, then prices would never change. Right. And, when you go to trade, you would have complete uncertainty. This is part of what Davidson was testing in terms of the variance analysis. You'd have complete uncertainty in terms of what would happen to the price when you go to sell, what the right level of the price was. And so like that to me is the part that I keep emphasizing, which is there's nothing I can really tell you as long as the flows into passive and it continues to gain share. The odds are very, very low that you're going to actually outperform it. Mechanically, if you think of a Sharpe ratio as the intercept on a y equals mx, or not Sharpe ratio, I'm sorry, alpha as the intercept on a y equals mx plus b equation, and you raise the passive share, raising those returns by multiple expansion over time, you actually force alpha's negative. It's just a mechanical output from using a linear equation on a curved surface. It corrects itself just like my XIV trade, and that active will somebody who's holding 5% cash will fantastically outperform if the stock market falls 50%.
So Davidson, Mike has a chart which shows when civilization ends at some percentage of index. Although since you guys seem to not know what percent we're at right now, that makes it challenging. But Davidson, where is that point where the inflection point, and using some kind of projection of cash flows now with rules and regulations and bank are getting all this stuff, when should we expect civilization to end?
There's a great question, Harley, and
I want to get out the day before I'm going to get out.
Yeah. No. Well, I exactly. That's the hindsight is 2020. So I learned this trick from John Cochran, who I took asset pricing from in Chicago. I try not to make predictions because then I can never be proven wrong, right? Ex post. But yeah, I would say we really don't know. So one thing that I will say about our analysis on this particular paper. Now, there's other.
What that slide that you have, where you have little.
I can share a slide. So I mean, this is
let's see Mike's prediction.
It's just a very simple illustration of what would end up happening if passive continued to gain share. And we have a partial competitive response in line effectively with Haddad. Right. Yeah. That you end up seeing as passive gain share is that relative valuations versus your starting point accelerate upwards over time. And with that volatility, right? For the very simple reason that as fewer and fewer, this goes back to Bogle's observation that if everybody indexed, it'd be chaos, catastrophe. The problem is to facilitate liquidity in the market, the remaining active holders have to have incredible variability in their position. They have to basically hold a ton of cash in order to facilitate the liquidity that everybody else wants. And so, just mechanically, it can't actually happen. It's much more like a predator-prey dynamic. If there's a ton of bunnies, then you can have explosive growth of coyotes. If there's a ton of coyotes, bunnies don't stand a chance. And once the bunnies are gone, the coyotes have to start consuming themselves, right? That's the same underlying framework that is playing through here. Now, you'll notice that we go off the screen, right? And the simple reality is, like I've shown this and illustrated it elsewhere, like there is theoretically a point as you approach 90+% that like you see Shiller PEs in the 500 range. I mean, it's absolutely insane. But long before you get there, the uncertainty and volatility, which I would argue we've actually started to see already, is going to increase because of the loss of elasticity in the market. And at that point, it becomes not an if, but a when that you experience a market event that effectively is a life-changing outcome for many people in the markets.
Yeah, I mean the one aspect of finance that I think is still true is that holding cash flows constant, a higher price is going to be followed by a higher PE ratio is going to be followed by lower returns in expectation going forward. And
Why? I mean, the whole point of this discussion is that value doesn't matter at all. It's all flows.
Well, so I'll let Davidson answer this, but Harley, I just want to emphasize what we're actually describing is not a system that has been changed so fundamentally that nothing remains true. What we're actually saying is there is an external forcing that has been created there. It's like think of your kids and my kids, right? There have been multiple occasions where exposed to their own stupidity, they would have driven themselves into bankruptcy or legal trouble. But because we chose to step in at various points in time to fix the issue for them before it got out of control, they were able to keep going. This is the same underlying phenomenon, right? We have a loading that is being created, a forcing that is being created by directed passive flows. The government has designated passive as the preferred mechanism for investment for US retirement systems. That's an extraordinary, like one of the things that I always run into in these discussions. I'm actually having dinner next week with Cliff Asness, in which I know one of the primary topics of discussion is just going to be the libertarian ethos that nobody should tell anyone what to do. And my point is super straightforward. They're already being told what to do, right? I mean, we have blessed a particular type of investing. We call it passive investing. We've blessed it with liability protection that no other investment strategy has.
so let me ask a more nuanced version of Harley's question.
That's not hard, by the way,
That's
David.
not, yeah, exactly. And maybe this is more interesting and more informative, which is this is not going to happen, uniformly across all markets, as we said, all at the same time. It's going to happen more and faster in some markets than others. It probably would be much less of an issue in, say, the bond markets, because like we said, the bond markets have this like fundamental tie to value that gets realized every 5 or 10 years or whatever the maturity is, and stocks don't have that, et cetera. So which market sectors then could we say like what's going to be the canary in the coal mine?
Yeah, it is a really interesting question, and my argument would effectively be that it is ultimately the super large cap stuff. So if I jump to an extension of Valentin Haddad's work, this is my analysis, just to be very, very clear, building off of Valentin Haddad's work. But as passive share gains, all stocks become more inelastic, but the largest stocks, right? So those are in the 3+ trillion, like the multipliers I'm getting at this point are just absurd. And this is reflected in Haddad's paper, where you can see that there's effectively zero elasticity in the few stocks that make up basically the absolute pinnacle of the S&P 500, for the very simple reason that you cannot not buy them, right? I mean, I can replicate an index and decide to exclude Delta Airlines, although today that'd be a bad choice. Can I leave out Microsoft or Apple or Nvidia? And I
It is
can't.
7% of the 500 now, right?
Right, exactly. My tracking error would be completely unacceptable. So I have to buy those names.
Hey, Mike, we had a case of 100 PE on a G7 index, 30, 40 years ago with Japan. Is it possible that Japan had a passive index phenomenon there that drove those stocks to 100 PE?
Interestingly enough, they actually had something very similar. So the cross holdings effectively created that hodling type characteristic where they were owned for strategic purposes, not for valuation purposes. And so effectively there was very low float. We saw the exact same thing play out in the Chinese stock market in 2014, 2015, when it rose almost 600% over the course of 6 months. And it was strictly a function of Western investors trying to buy China in a manner that the Chinese market wasn't built for, right? They were basically buying futures in Singapore because they did not have qualified financial institution status. That meant they were trying to buy things in proportion to their market cap. And you had, crazily enough, had stocks in the the Shanghai index that had less than 5% of their float out there. And so, like I know you remember this work that I did when I was at Ice Farm, where we did the analysis on what was driving the Chinese stock market. It was literally stocks going limit up every day with zero transactions happening. right? At one point, you had one stock in the Chinese stock market that didn't trade for 32 consecutive days and went up 10% every single day. 1.1 to the 32nd power is a big number. I don't care how small you are.
Okay, so despite the fact that this is an entertainment only show, what is the lesson over here for investors? Like what, with knowing all this and accepting it as truth, what should we be doing?
Let me grab the wheel for 1 second,
Please.
because Mike teed up this little bit of analysis that I did, which I think is really, really changed my priors. Okay, so, and I want to mention it. So first thing, I do really appreciate that Mike is trying to introduce hodling as a technical term now. But second point that I want to make is that, so very quickly, if I can talk about this, my colleague at the U of U Eccles School of Business, Jack Hui Lee, super, super, super smart guy. Again, probably conservatively 1,000 times smarter than me. His whole thing is measuring price elasticities. And so he was kind enough to furnish some data, which I then ran some analysis on. Okay. And the idea is the following: you look through, or Jay looks through the entire TAC, the tick by tick data, and signs every trade over whether it was buyer initiated or seller initiated. Okay. Microsecond basis. And then you stack that up per day, per stock by day. And you say, what was the order flow imbalance of like how many buyer initiated trades versus how many seller initiated trades? And then you regress the return on that day. Right? If the stock is perfectly elastic, then there should be no correlation, right? That slope should be zero, because whether a bunch of trades came in that were buyer initiated versus seller initiated, it should not make a difference to the fundamental return on that, to the return on that day, because it's perfectly elastic. And the extent to which there's a price impact on that order flow imbalance day to day is a pretty good measure of the stock's elasticity. So if we look at that and we look across all non-microcap stocks, you see a positive correlation, a very strongly positive correlation on average. So on average, stocks are a bit inelastic. I think we can all understand.
Well, and I want to emphasize, actually, this is median, not average, right? And one of the key things about using medium here is that it is bounded at zero and it is unbounded to the top side, right? So the averages are probably even more skewed than this.
So it's not bounded at zero, but it is bounded. It is much less sensitive to the outliers on either end. That's okay. Correct. And so we can see, if you look across, like starting in 2011, we had a price response, median price response across all non-microcap US stocks of like 1.4 or something like this, or 2.5. And then it's just been rising, rising, rising. Unfortunately, the data cuts out at 2021. And the really interesting part was Mike and I had been talking about his thoughts about the mega caps in specific, and like NVIDIA, Microsoft, and so forth as well. So I said, okay, let me focus it only now on these mega caps, in particular the S&P 500 stocks only. And they are actually driving the vast majority of this increase in price impact, which is to say inelasticity of stocks to flows. And that's very unusual, because usually as an academic, whenever anyone finds any pattern in like all the stocks, right, that they claim is going to generate alpha or is going to tell us something, if you look, it ends up being all in like the micro caps and the small caps, because that's where kind of stocks are very uninformative and illiquid and so on and so forth, right? The very elastic, very price efficient stocks are these giant mega caps. But that's not what we're seeing here. We're seeing the opposite. In fact, through 2010 all the way up to 2014, the giant mega caps were virtually perfectly elastic, the market, according to this measure. And since then, the elasticity, the price impact has skyrocketed, which is to say they've become substantially inelastic in their price response. And that is a little shocking to me. And I have to admit, I'm way over, I hate agreeing with Mike on everything or anything for that matter, but this analysis kind of pushed my priors a lot more to where I owe Mike a beer.
Does QE matter here?
Pardon, Harley?
Does QE matter? The government printing money?
Oh, it's a good question. Mike, your thought?
Well, my immediate reaction is it has an impact, but it's more through the portfolio rebalance channel than it is through any form of discounted cash flow analysis or anything else.
So through flows, not through fundamentals.
Yeah, I mean, the way that would work, Harley, is if the government is shrinking the quantity of bonds that are available, the price of bonds are going to be driven up. If I have a systematically rebalanced fund, that means I'm going to sell bonds and buy equities, right? And so like that's the portfolio rebalance effect. The whole narrative that the reason valuations were really high or that growth was dominating was because interest rates were super low. The only argument that people still have on that is, well, interest rates are still super low. I know that's kind of where you would come out. I don't see that at all. But we went from 0% rates to 5% rates, and we had the exact same leadership, exact same behavior. Nothing changed. It's all perfectly explained by the portfolio rebalance channel as compared to any form of fundamental analysis or work.
So Mike, relative to, so Harley's question was about the 100 PE in Japan, and your point was, yeah, Japan had this kind of cross-holding effect that drove an effective
passive type dynamic, yeah, very
type
similar.
dynamic. Japan didn't have a massive crash and unwinding, though. It just kind of sucked for like 30 years, right? Is that?
Oh,
I call it a crash.
You're showing your age. You're forgetting the December
I
1990.
think 80% is a crash.
80% is a crash. Okay, fair.
The Nikkei fell from, I think it was 40,000 at its peak to, I think it troughed 2 years later. I think it was 12,000, something like that. So
Or lower.
I would consider that a crash.
Fair.
Okay, so we have a couple of questions that I want to hit, and then I want to finish with a poll. One of the questions is asked, and this is one that I get asked all the time, right? What role do generational wealth transfers and demographic trends play in here? And this is one that I have my thoughts on. One of the key things that I would emphasize is that contributions are always going to be a function of income levels, right? You can only save out of what you earn. You could theoretically lever it a little bit, but even that has its limits associated with it. Withdrawals, on the other hand, are always going to be a function of wealth levels. And so perversely, as valuations rise, the propensity to take money out actually rises relative to the contributions and ultimately addresses the point that I think Harley was referring to, which is this is ultimately self-correcting. It's just a question of how painful it is when it self-corrects. So I believe that generational wealth transfer and extended lives and the accumulation of wealth and the ability to borrow against it, et cetera, has certainly contributed to it, but I don't think that it is the answer to the issue. Davidson, what's your reaction to that one?
Yeah, I mean, once again, you might want to look at Japan as that didn't save them, and Japan has been graying way ahead of the USA, right? And has had an extraordinarily long expected lifespan, centenarians, and lots of centenarians, et cetera, et cetera. So I think
most of which we're finding out, by the way, now are actually don't exist.
Oh yeah. No, it's all
largely
it's all insurance fraud. It's all social security fraud. Yeah.
Yes.
But the point is, yeah. So those exact demographic trends did not help Japan, is what I would say, right?
Yeah, that's my conclusion as well. And in fact, if we model the demographic bubble of the baby boomers through, we actually end up seeing what we're starting to see, which is net negative retirement flows, because the assets are held by old people and the remainder is not. Now, there is a component, and I will absolutely accede to this, the rise of generational skipping trusts and intergenerational wealth at the extreme high end, the fact that a majority of assets in one form or another are held by extremely wealthy private individuals, but that's often confused with the stock market, right? The ownership of the extremely wealthy individuals of the stock market is very, very different than the equity that they hold in businesses of their own, private businesses, real estate, et cetera, which is where those wealth metrics are ultimately coming from.
So let me ask Mike a related question: the rise of private and the and the decacorns and the decline of IPOs and publicly listed firms at all. Is that a help because they don't have to mark their numbers every single day?
Well, I think the volatility laundering to, again, steal from AQR and Cliff Asness absolutely plays a role in terms of allowing them to do stuff that would be very hard to do in the private markets. And I do think that the rise of private markets perversely actually is both being positively influencing your ability to buy something, right? It's really easy to buy something if everything else is trading at a much higher premium in the public markets. You can create an investment case that says, I will buy these private businesses, roll them up to scale, take it public, and I'm going to exit. But the flip side of that equation is when you get to the point that the marginal flow is more than 100% passive, which is really where we are today, getting IPOs out is impossible, right? An IPO by definition requires active managers to step in and say, I'm going to deviate from my benchmark. And everything we've talked about says that's harder and harder and harder to do. And hence we have the problem that's emerging within private equity and venture capital, which is an inability to get stuff public.
Hmm.
So we come back again to like, what should you do? And my answer to this increasingly, and I'm not going to share the research right now, we'll include it in our quarterly call coming up next week, I believe it is. But when you look at the implied forward returns from a valuation framework, we've actually really crossed into a model that we've only seen, unfortunately, two other times really in history, which is, unfortunately the 1920s and in the late 1990s, early 2000s, which is where valuations have just gotten so extreme that unless you actually think this can continue in perpetuity, which I do not, you almost inevitably should be paying attention to the thing that nobody else is paying attention to, which is bonds.
Yeah, I mean, with the small addendum that if we continue to run trillion-dollar deficits every single year, even in boom times, even bonds might look a little hairy at some point, right? And
Well, they definitely do look
venture,
hairy right now. That's
yeah. I'll give another shout out, which I can't give enough shout outs to, the research of a great guy at University of Arizona, Scott Cederberg, who has looked at the US 20th century data and even the first world data of all first world countries is rife with survivor bias. There's lots of countries that started the 20th century in fine fettle and it didn't work out so good for them, and they're not in the data, right?
Yep.
And so his argument has been for like a decade now that foreign stock markets are really nice. They provide a kind of the opposite of a double whammy, a double bonus in some sense, because if your domestic stock market is crashing, your domestic bonds, government bonds especially, also tend to crash at that time, and there tends to be rampant inflation, right? Historically speaking. And so you actually get a bonus from having your money domiciled elsewhere and denominated in other currencies.
Yeah.
Davidson, my advice is not to get hung up on IQ. Mike is 50 times smarter than I am, but he's been dead wrong on rates for 4 years now. So what do you do?
It's just going to happen. It is going to happen. I might frame it differently and say the Fed has been dead wrong on rates, but that's okay. They get to choose. I don't. Okay. Let's actually jump to our poll. We're going to close with our poll instead of opening with our poll because I wanted to make sure everybody had the information that's available. We unfortunately cannot vote. I will tell you what my vote is afterwards, but let's see what the audience response is after listening to us. Wow.
T-bill.
Look at that. T-bill and chill. Interesting. That's a higher number than I would have expected. I was sincerely hoping that our audience would discard everything I had to say. That's very interesting. Harley, are you surprised?
Well, I mean, look, people are going to call it top of the market. I think if we allowed to have more than just one category, I mean, look, I tell my kids, 70% SPY, 30% AGG. Call me in 30 years after you compound. That's what I think. I mean, I don't trade single name stocks. I'm too stupid for that. I trade bonds and currencies.
Well, this is like we've got a real conundrum here because I am the dumbest man alive. Davidson professes to be even dumber than I am, and you profess to be 50 times dumber than me. Like, I don't know why anyone's watching this program, but with that, that's probably a great place for us to wrap up. Davidson, thank you so much for joining us. You're such a great sport, and you've really been fantastic to get to know and to interact with. I look forward to collaborating with you in the future. Harley, I'll continue to hang out with you every once in a while. And Clint, we're going to hand it over to you. Thank you very much.
Thanks everyone for joining us. It was a very entertaining, as I promised. Can't believe we had to wait 50 episodes for a bunny IO analogy, but let's see what one brings. Be sure to register for our next Keeping It Simple, taking place August 7th, when Mike and Harley discuss gold with Dana Samuelson of the Gold Exchange. Thanks, everybody. Appreciate it.